Whew, babies and taxes. They're both going to cost you a lot of money. Taxes are going to be forever, so at least with kids, they should move out when they're 18. But with this generation and future generation, looks like they're staying more to like 30. And here's a tip on how to teach kids about taxes. Just eat 30% of the ice cream or take 30% of their iPad time away. I'm Fook with Alpha B Group, and today we're going to talk about kids and taxes. So if you're having a kid soon or you already have a kid, this video is for you. I want to go through a simple overview of what you should think about when it comes to kids and taxes. And these are items that you can actually start doing now, but I'm not going to go through extreme detail because each item could have a whole video on its own. So the first one I want to talk about is college savings plans. This is the easiest ones to start setting up right now. You have two options. You have the 529 college savings plan or the Coverdale. Now 529 is going to be the most popular one, especially if your income limit is over about $220,000 as a married couple. Mainly for my clients, because their income is over that limit, they're going to do a 529 college savings plan. The benefit here is that it's $15,000 per person per child, meaning that if there are two parents, then each parent could give that same child $15,000 each, so a total of $30,000. The other great benefit is that with 529 college plans, you're able to front load it, meaning that you could put 5 years worth of contributions into a child's account in the first year. So you'll put it in 1 year, and the next 5 years you won't be able to contribute because you're already putting 5 years worth in. So technically it's 30,000 times 5, which is $150,000 maximum you can put in for that first 5 years. It's a great way to front load because it just allows for more money to be invested in and grow longer tax free. For Coverdale, I don't know that many people who use it, mainly because of the income threshold and the low limit that they allow for the contribution. But pretty much if you're filing single or head of household, if your income is over $110,000, you can't contribute. And if you're filing as a married filing joint tax return, if your income's over $220,000, you can't contribute to a Coverdale. Now with the Coverdale, you can use it to pay for elementary school and high school. 529 plans actually allows the same thing because of the Trump tax reform, but that's going to expire in year 2025. But in general, I wouldn't suggest using college savings plans to pay for elementary school or even high school, mainly because you want this account to grow for as long as possible. So you're going to want to use it for college because it's going to have more long-term tax-free growth. So with 529 plan and Coverdale, they both don't offer any benefits when it comes to taxes immediately, meaning that whatever money you put into these plans, you don't get a tax deduction for it. Instead, the tax benefit is that when the account grows, it's going to grow tax deferred. And then if you use those funds to pay for college, none of it's going to be taxable. So it's pretty much tax-free income. So keep these two accounts in mind because these are two easiest ways to help fund college and keep a savings plan that's going to be tax-free for the kids. And the next thing I want to talk about is dependent care FSA. So the first thing is that if you plan to have daycare service or a nanny service, then definitely ask your employer if they offer a dependent care FSA. What this is that it's going to allow you to contribute to this FSA fund where it's going to be pre-tax, and the money that you use from that is used to go help pay for daycare costs. So for 2021, the maximum benefit that you could put into your dependent care FSA is like $10,000, a little bit over $10,000. If you do that, then you're saving, if you're in the 37% bracket for federal and California, you're probably saving about $4,700 in taxes just by contributing to that and using that. For most of my clients, they're going to spend more than $10,000 in daycare costs. So definitely take advantage of this this benefit through work. Also make sure that if you say you're a single parent, as long as you're working, you should qualify to take advantage of this. Now for married filing joint, both spouses or both parent would have to work to qualify to get this benefit. So any stay-at-home moms or dads, unfortunately, that would disqualify you from using this benefit and getting a tax benefit from it. So this is mainly going to be used for daycare or nanny services, but it also works for summer camps. Now for summer camps, it can't be one of those overnight summer camps. It has to be just a day summer camp where you have to pick them up later on. But also keep in mind that anything that helps you work in a way where you need someone to help take care of your kids so you can go to work. That's usually the general rule of why the IRS will allow this tax benefit. Now for nannies, this is a whole different different topic that could take a whole nother video that I plan to make later on as well. For nanny, you got to keep in mind that with nannies, there's special rules called household employee tax that you have to file. And it gets a little, not a little, it's actually very complicated to do because you have to hire another payroll service. And as a nanny, if they come to your house, then they act as your employee. So you have to treat them like an employee and give them a W-2. But with daycare services, you don't need to worry about this because you're usually bringing the child to another location, and that's considered the daycare is considered a business. So then you don't have to go through the whole employer-employee relationship like you do with the nanny. So take advantage of this dependent care FSA through your work. Now keep in mind that the annual contribution limit to this dependent care FSA is only limited to per family, meaning that even if one spouse has the ability to put into a dependent care FSA and the other spouse also has the same plan through their separate work, you can't double up on that. It's only one total. So usually it's just a lot easier to have one parent take the full amount when it comes to the deduction. Now, the next thing I want to talk about, this is specifically for business owners or rental owners. If you have a child, you could actually have them have a Roth IRA if you pay the child through the business or through the rental. Now, there's very strict rules when it comes to this, and it's a whole nother video that I'm going to make. But in general, keep this in mind that if you are a business owner or you own rental property and you could hire the kids through one of those, then you could actually hire the kids, pay them, and use that funds to fund their Roth IRA. And I actually think the Roth IRA is a lot better for kids than, say, even a 529 plan that I discussed earlier, mainly because a Roth IRA, pretty much it's going to grow tax-free for a very long time, so up into the retirement. So if they're even as young as 3, 4, 5, and somehow you're able to hire them for your work, you can actually put into a Roth IRA and let that sucker grow for another 65 years or so. And that's going to be very beneficial, especially if you do it year after year for the next, say, 7, 8 years before they're 18, it's going to benefit a lot. But also with the Roth IRA, just like the 529 plan, you're not able to get an immediate tax deduction for it. It's not going to help you at all on your taxes currently, but the benefit is that it's going to grow tax-free. And that tax-free growth, especially for someone so young, is going to be enormous. And now the next thing I want to talk about is medical expenses. Now, because they're your dependents, any medical expense that cost you anything, you get to deduct it onto your personal tax return as well. Just keep in mind that for most of my clients, they're not going to be deducted because there's all these different rules on who qualifies. But I would say just keep track of it just in case, because you never know that you might be able to deduct it in case there's one year where there's a lot of medical expenses. Now, the most common thing I see with a lot of my clients is they are taking their own investment and transferring it under the kid's name and selling it under the kid's name and social security number, thinking that because the kids don't have any other income that they're going to be in a lower tax bracket. That does not work, and this is called a kiddie tax. A lot of people try to do this in the past. IRS caught up to them saying, no. What happens is that if you transfer any stocks or any funds under the kid's name and it earns interest, dividends, or even stock sales under their name, the first $1,100, the IRS will be like, okay, we'll tax it at the kid's rate, which is almost zero. But once it goes over $1,100 of earnings, so say dividends and interest and then stock sale gains is over $1,100, now the IRS says that's going to be actually taxed at the parent's rate. So you can't escape that whole tax rate by trying to transfer your assets over to your kids because it's not going to work. So this rule is going to apply to kids that are 19 and under, but also if they are in college and 24 years and under and still your dependent, then they also follow under the same rule. So trying to trick the government into moving your assets over to your kids is not going to work. So the next thing I want to talk about is adoption credit. Now, I've only done a couple of these in my career, but the ones that I had done it for, it's a huge credit, like up to $14,000. Not only that, there are some employers that will help pay for the adoption fees and other costs associated to adoption. So if this is something that relates to you, definitely look into this. Having kids is definitely way more expensive than the tax savings you're going to get. At least the tax savings will help subsidize for maybe like 6 months worth of diapers. But other than that, I'm Fook with Alpha B Group, and I'm off to my next video.